Brad Williams, Frugal Finance. Cross-hedge with faulty expectations. In the preceding example, the vice president misunderstood the nature of the futures market. If the vice president had understood everything correctly, table 515 would have shown a zero total wealth change. Thus far, all the examples have been of perfect hedges having total wealth unchanged. Sometimes, however, even when the hedge is properly initiated with the appropriate expectation, those expectations can turn out to be false. In such cases, the hedge will not be perfect. Total wealth will either increase or decrease. So here we have this VP plans to sell 90-day commercial paper in 3 months in the amount of $1 billion at an expected yield of 18%, which should net the firm $955. The VP sells 1,000 T-bill futures in 3 months with a future yield of 16%, a futures contract per price of $960 and a total futures price of $960 million. The spot commercial rate was expected to be 18% at the time, but is really 18.5%. Consequently, the sell of the $1 billion of commercial paper nets $953.75, not the expected $955 million. T-bill futures contract is about to mature, so the T-bill rate is equal to spot rate equals 16.25. The future price is still $953.375 per contract, so there's a gain per contract of $625 and a total gain of times 1,000 contract is $625,000. Net wealth change $625. To show this possibility, let's assume that the same basic hedging problem as in the cross-hedge example. In particular, assume that the VP wishes to hedge the same issuance of commercial paper and that the yield curves are as shown in 5.3. The actions and expectations of the VP shown in table 516 are exactly correct. The yield curve hints that in 90 days, the 90-day T-bill and commercial papers will be 16 and 18%. However, in this instance, assume that these expectations formed are incorrect. Over the 90-day period prior to the issuance of the commercial paper, the market opinion viewed the commercial paper as being much riskier than anticipated, with the economy experiencing a much higher rate of inflation than anticipated. Historically, assume that the yield premium of commercial paper has been 2% above T-bill rates, consistent with figure 5.3. But now, due to the perception of increased risk for commercial paper, the yield differential widens to 2.25%. Also assume that in 3 months, the T-bill rate moves to 16.25, rising due to greater than anticipated inflation. Under these assumptions, the commercial paper rate is 18.5%, not the original, forecasted 18. As table 616 reveals, the total gain on the futures position is $625,000. Due to the commercial paper rate being 18.5%, not the original anticipated 18, there is a loss on the commercial paper of $1.25 million. Since the error on expectation was 0.5% on the commercial paper, but only 2.5 on the T-bills, the gain on the futures does not offset the total loss of the commercial paper. This results in a net wealth change of negative $625,000. However, the loss would have been $1.25 million without the futures hedge. So again, when you go in and you start messing around with these strategies, you can see it's not just simply making some assumptions and what have you. It's an ongoing process and evaluation on a daily basis. And remember, tailing the hedge, always keep that in mind. You might need to make adjustments on a daily or weekly basis. A cross hedge between corporate bonds and T-bills, cash market, futures market portfolio learns he will receive $5 million to invest in 5% 10-year AAA bonds in 3 months with an expected yield of 7.5% and a price of $826.30. The manager expects to buy 6,051 bonds. Portfolio manager buys $5 million face value of T-bill futures, 5 contracts to mature on June 1st, with a futures price of 6% and a futures price per contract of $985. AAA yields have fallen to 7.08%, causing the price of the bonds to be $852.72, representing a loss per bond of $26.42. Since the plan was to buy 6,051 bonds and a total loss of 601 equals 159,867. T-bill futures yield has fallen to 5.58%. The futures price, spot price, equals 986.50 per contract. Since 5 contracts were traded, the total profit is $52.50. Net wealth change, $154,000 loss. Out. You can see when you're playing this fixed income game and you're moving a lot of money around, be careful. And I'll explain more as we move forward here. In general, real world hedges will not be perfect. Rates on both sides of the hedge tend to move in the same direction, but by uncertain amounts. On occasion, rates can even move in opposite directions, generating enormous gains or losses. In the example just discussed, assume that the commercial paper rate turned out to be 18.5%, but the T-bill rate was 15.75%. Below the expected 16% in this case. The loss on the commercial paper would be $1.25 million. The loss on the futures would be $625, total loss of 1 point. Since the company losses on both sides of the hedge, such an income unlike, all right. So this right here should be up here, but just go with it, all right? I'm just giving you this really off the wall example here. And I'm gonna go back. On occasion, rates can even move in opposite directions, generating enormous gains or losses. In the first example just discussed, assume that the commercial paper rate turned out to be 18.5%, but that the T-bill rate was 15.75%, below the expected 16%. In this case, the loss on the commercial paper would be $1.25 million, and the loss on the futures would be $625,000, for a total loss of $1.875 million, and the VP looking for a new job. It's the company losses on both sides of the hedge. Ouch. Such an outcome is unlikely, but it is possible, of which hedgers should be aware of. Brad Williams, Frugal Finance. Thanks for watching.